Morning, and many thanks to all for joining this morning's briefing on the provisional national accounts and international accounts for Quarter 3 2023. We'll take questions at the end of today's presentations, and can I ask people to use the chat function if you're online for questions, or obviously raise your hand and we can organise you to come off mute to ask a question as well. And we have some attendees in the room here today, so we'll be able to take questions from the room also. So today's results are showing a contraction of 1.9% in GDP in Quarter 3 2023, driven largely by a decline in the multinational dominated industry sector. Varied picture for activity across the other multinational dominated sectors and the more domestically focused sectors. So this morning's briefing will take us through the detail and the breakdowns of the key time series to help us to understand what's happening with that M&E activity and to see what's happening also in the underlying domestic economy. As I always say, slides from the briefing are available along with the statistical publications on the CSO website, and we hope to make a recording of today's presentation available on the CSO YouTube channel. Again, just to emphasise, our contact details are available on the publications and on the press release for today, so please contact us at any stage with queries on today's results or on any other aspect of the national and international accounts. So I'll pass to Chris and then over to John to take us through the results for the national accounts and international accounts for Quarter 3. Thanks, Chris.
Thanks, Jennifer. So I have the Q3 2023 results for you for the national accounts. And I'll start off with our infographic and our headline that GDP is down 1.9% in the quarter. So that's quarter on quarter down 1.9%. The two methods we have of measuring GDP, the output method on the top of our infographic and the expenditure method on the bottom. The output method, first of all, has a decline in industry down 3.5%. The first two bubbles there are the M&E dominated areas, industry and information and communication. Industry is bigger, but one's up and one's down. So information and communication is showing growth across a whole range of indicators. The labour market data, value added, exports, imports, while the industry data is down 3.5%. But I guess the story of the quarter is that while we have that volatility maybe in the M&E data, the domestic sectors moving then across to the right, that they're down. Not just one or two, but many of the domestic sectors are down marginally. So in particular, distribution, transport, hotels and restaurants down 1.2%, and the construction sector down 1.2%. So that set of domestic sectors is really reflecting the overall domestic result for the economy on the output side. On the expenditure side, so all the money that's spent in the economy, working along the bottom of the infographic, personal consumption on goods and services is up marginally. And remember the story behind that data. In money terms, it's up quite a bit, but with 5 to 7% price increases, you're getting that real increase in consumption or volume increase of only 0.7%. Government expenditures up 1.7%. That's mainly related to wages and the public sector wage bill. Investments down 3.7%. Some of that is aircraft, but even the modified investment number is also down. I think that's down 3.6%. I'll talk about that in a little bit. The traded part of the economy, exports and imports, both down. Exports down 2.1% and imports down 1.7%. Exports is bigger. So the net effect, the net trade has exports or net exports down. So we bring that whole expenditure side together and the output side, and the combination gives us that GDP result down 1.9%. The modified measure then the bottom left of the infographic, modified domestic demand. So that's personal consumption, government expenditure, and then the modified investment number. Adding those all together, it's essentially flat. There's a tiny negative on it, but it's essentially flat like a lot of the indicators that we have today. If we look at the data, the headline items across time, that'll give you perhaps a second story out of today's data. With some revisions to prior quarters, we now have a run of 4 negative quarters of GDP, and MDD is negative in 4 out of the 5 quarters. Only the Q2 2023 is marginally positive for the domestic indicator, modified domestic demand. If we look versus the data versus the estimate we produced 30 days ago for you, that the frontier release came in quite close, I guess this time, at minus 1.8%. So that's 30 days ago, we have just the output method that gives us that minus 1.8% result. And then today we have enhanced data for the output method and a second method on expenditure that gave us the result in at 1.9%. So not too much change over the Frontier series estimate 30 days ago. In comparison to some available European peers at this stage, that 1.9% is, as we usually are, in the left or the right of the graphs, on the left this time, alongside Finland and Austria, while we're showing growth in Cyprus and Poland, with the EU 27 right in the middle of the graph, close to zero. A little bit more detail going through the two methods. First of all, the output method, where we can weigh up all these percentage changes from the infographic and say, well, how important are they? And if we look at the two MNE sectors, industry and information and communication, or if we weigh them all up, we know that the MNE sector's share of GVA is about 52%, and we can see that the big industry sector is down 3.5%, while information and communications up 3.1%. So that's kind of half the economy with that mixed data, some up, some down. But then we move to the right of that chart, we can see a lot of the domestic sectors. And while some are up, including public admin and real estate, we can see that many of these domestic sectors are down, particularly finance, construction, and the big domestic sector that we use as kind of a bellwether for the economy, distribution, transport, hotels and restaurants. Looking at all those sectors across time, and again, selecting out the ones that I like to pick, the two big M&E and the two big kind of domestic sectors here. What are we seeing across time? We're seeing that continued rise in ICT, information and communications, software. So this is software exports, web licensing, product localization, all that work that's done in information and communications. That's seeing that continued rise in the economy. We're seeing the recovery there really of distribution, transport, hotels and restaurants in blue out of the COVID period. And we're seeing those falls, I guess, in construction and industry. But for all of these, I'd caution you too much about looking at just one quarter's data. 2022 was a very strong year for the M&E sectors. And what we're seeing so far in 23 is that the year is going to still be considerably bigger than 2020. And definitely a lot bigger than 2019 pre-COVID. So even GDP is up over 30% on 2019, the pre-COVID levels. So certainly we're watching all this data changing quarter on quarter, but there is a big picture out there of substantial growth across a long period of time. If we look at the more high frequency data we have then on these sectors, so the CSO's Industrial Production and Turnover Index, what's that telling us? Well, that's showing us that big high in 2022, the green line here showing us that large increase in 2022, and some of the volatility we've seen the fall into March 23. And essentially the results are fairly stable over the quarter, month on month for industry. On the services side of the economy, the monthly services index, that's telling us essentially through the quarter what happened. That we see growth in each of the months for the information and communication sector, and some mixed results, I guess, perhaps for some of the other sectors. When we weigh them all up then, so that's weighing up all of industry and all of services, we can see the M&E dominated sectors, and then the other sectors, which we often refer to as kind of the domestic sectors. And then for the first time in a while, well, after COVID, I guess, we're seeing those domestic sectors with a small negative, minus 0.7%. So that's that green bar there. So while they've been positive the last number of years, I guess, that's the first time we've seen the full run of domestic sectors with a small negative result. To add some more evidence, I guess, in there about what we're looking at, we can look at the wage bill, so the total cost of employing people in the state. This is coming out of our high frequency data that we have from revenue on monthly employment, and you can see that in another CSO series, or even if you look at last week's labour force survey data, where there was year-on-year growth, but if you look quarter on quarter like our figures today, you'll see that it's largely flat. So the numbers of people employed are largely flat between Q2 and Q3, and that's the result we have here in the constant price seasonally adjusted wage bill of zero or flat between Q2 and Q3. Within that, You can see that strong result for the information and communication sector with growth. And you can see the public admin, education and health is up. But through the other sectors, I guess you're seeing kind of a run of falls, especially in these big domestic sectors here. You're seeing a run of negatives. And that's helping us understand a little bit about why that overall domestic sectors data is down slightly at minus 0.7%. The wage data also tells us about the MNE share. This is current prices, but the share in it is remained the same. So the MNE contribution to the domestic wage bill is still at 35%, just below 35% in the data. If I move to the second method, the expenditure method of looking at the economy, we look at personal consumption, government consumption, investment, and the traded sector, exports and imports. The black line is our GDP. Stripping away the multinational data leaves us the blue line, modified final domestic demand, and that's that zero or minus, a very small negative for modified domestic demand. So that builds up from the small growth we're seeing in personal consumption, the 1.7% growth in government data, and then this residual here is the modified investment number. Now that's down 3.6%. Through a pattern of, again in 2022, very large expenditure on machinery and equipment, but really the data in Q3, there's a couple of things going on there. When we take out the aircraft, we've got some domestic data to look at in terms of domestic software investment down slightly. That's probably what's driving the modified investment numbers. If we look at each of the components then, so consumption, and investment in particular on the expenditure side, we see consumption's up 0.7%, split between goods and services. This is all seasonally adjusted. If we look at the unadjusted data, we can see the pattern of what it is that's driving goods and what it is that's driving services. So looking at the year-on-year comparison, we can see the same picture as we've had now for a number of quarters, that it's cars driving the goods, increases in consumption, and it's the return to foreign travel and to public transport that's driving the services data. So that's a consistent pattern we've had now for nearly 2 years, I guess, in the consumption data. If we look at our household consumption then versus some available, there's only a couple of available other countries at this stage, we can see that small positive growth in Ireland compares perhaps to France and some stronger growth in Spain, while there's some falls in some of the other countries available, Austria, Germany and Slovenia. It's worth making the point, labouring the point a little bit, that we do, in money terms, we do see a lot extra spent in terms of consumption. When we take out our PCE deflators running at about 7% at the moment, so we take out the price effect and look at the volume, the amount of volume we're all consuming in goods and services. That's where we're getting the result today, only up 0.7%. And while price increases are still positive, largely positive, we're seeing that big gap opening up between what we have to spend and what we're getting in terms of volume of goods and services. In the CSO high frequency data, again, monthly retail sales, it tells us a little bit what happened within the quarter. Extra consumption in August largely, but a lot of falls then in July and in September across a range of data, department stores, clothes, pharma, fuel, a lot of things down in the other 2 months. On the investment side of the accounts, because of some confidentiality, there's no large IP in the quarter, but because of some of the suppression, we can say a little bit less than we perhaps want to about the investment data. In total, it's down 3.7%. Machinery and equipment's driving that, but most of the data behind that is aircraft bringing that down. So we like to adjust for that aircraft to look at the modified investment data. And that also is down because of some, as I said, some lower domestic investment in software or intangibles. So it's not really the declines there are not really related to domestic machinery and equipment. We talked about data centers previously, return to office. That's not the story this quarter in the quarter-on-quarter changes in Q3 23. Looking over time at that, we can see the various things going on. IP in 2021 These large amounts in 22 are all related to investments in plant, machinery and equipment domestically. And then the set of quarters we have in 23 is perhaps related to a lower level of investment or a different story in the data. Moving on to the last item on the expenditure side, net exports. This is also down in the quarter, and John will give you a lot more detail on this than I will, but I guess the big picture there for us is we didn't see a large rise in contract manufacturing that we were perhaps expecting to see in the exports. The exports data is down, and the imports data is down too, with exports being larger than net exports is also down. And that's probably what's driving the expenditure side of the accounts. Weighing it all up, this is where we just give weights to each of the items and look at decomposing the GDP growth rate. We can see it's the foreign or the traded side of the data that's driving that GDP decrease of 1.9%. And the final transition to GNP looks at the foreign outflows of profits or M&E profits, and that's down slightly in the quarter to 25.6 billion. But again, John will give you a lot more detail on the FDI income outflows or the net profits. Just taking a moment to weigh up the other ways of looking at the quarter. So we can look at it this quarter for GDP on the same quarter last year, down 5.8%. Or I think what's quite useful at this stage is to look at the 9 months of 23 over the 9 months of 22, and that gives us a GDP fall of 1.3%. So for people looking at the year and how the year is starting, the outturn starting to emerge, we can get a better picture from the 9 months over 9 months. We can do that too with the modified domestic demand or domestic measure, and we see this quarter over the same quarter last year down 0.4%, but the 9 months, which I think is a pretty good steer now for the year, is showing an increase of 0.8%. So 9 months of 23 over the 9 months of 22. And again, I'll just caution people about remember prices. Remember the big price increases that are going on. And that's probably one of the big factors driving this decline we're seeing in the run of domestic sectors, is the price effect is kicking in. So even though in money terms things are going up, and we take the price effect out, we have declines in volume terms. So the example there with consumption is to look at money terms. Consumption's up 9.9% quarter over the same quarter last year. But in volume terms, consumption is up 2.6%. So that gives you an implied deflator or a price change of just over 7%. You can do the same thing with GDP, and you'll see the price effect overall is a little bit less in GDP, and that's been declining over the last 3 quarters. So the GDP deflator was a lot bigger, and a lot of that's related to exchange rates as well in the traded part of the economy. I'll just finish up on the summary slide, but just to mention as well, last Friday we brought a note out on net national income to explain this new net measure without depreciation. And we put a lot of detail on that about what you do to get net national income, how deflators work for it. And we published that data in the summer, and we'll have another version of that data in the middle of next year. But the internationally comparable figures were all out last week, so we published that note last Friday on NNI. So our summary of the Q&A is GDP down 1.9%. On the output side, we see that it's industry driving that, while some increases in ICT, but the run of domestic sectors like construction and distribution, transport, hotels and restaurants are down, giving an overall result of M&Es down 3.8%, and the run of domestic sectors down 0.7%. On the expenditure side of the accounts, we've consumption up marginally, government expenditure up 1.7%, and then modified investment down 3.6%, giving us a modified domestic demand, or modified measure on the expenditure side which is largely flat, close to zero. The wage bills there showing also a flat result of zero, and the foreign profit outflows are down marginally over the last quarter. So I'll hand over to John now for the international accounts.
Thank you, Chris. So now I'd like to take you through the international accounts for quarter 3 2023. So first we can see here our infographic, which is a good summary of the results. We have goods exports of 72 billion euros and goods imports of 34 billion euros, giving us a net merchandise balance of 37.4 billion euros. Services exports of 93 billion and imports of 84 billion, giving us a services balance of 8.6 billion euros. and we have income inflows of 65 billion and outflows of 91 billion, giving us our net income outflow of 25.2 billion euros. And these all combine to give us our current account balance of 20.8 billion euros, or 16.2% of GDP. Our net international investment position at the end of September was minus 578 billion euros, and our stock of foreign direct investment in Ireland stood at 1.3 trillion euros. Looking at our current account balance as a percentage of GDP, again, with low levels of IP imports for the past few quarters, we're getting a much more stable time series. But we've had a slight increase the last couple of quarters with increases in the current account balance. And so we have our current account balance in Q3 23 of 20.8 billion euros, or 16.2% of GDP. Looking at the current account a bit more closely, our merchandise surplus of 37.4 billion euros is down 16.2 billion on the same quarter last year. And our services balance of 8.6 billion is up 10.6 billion on the same quarter last year. Our net income outflows at 25.3 billion have decreased by 16.6 billion on the same quarter last year. And these all combine to give us a current account balance of 20.8 billion euros, which is up 11.2 billion on the same quarter last year. Looking at this balance over time, we can see here the quarters with the large negative services balances in Q4 20, Q4 21 and Q4 22, signifying larger IP imports. Comparing this quarter to last quarter, we can see that our merchandise balance is down by 1.1 billion euros, while our services balance is up by 1.2 billion. Our net income outflows are up 4.8 billion, which is a decrease in the outflow. And these combine to give us a current account balance which is up 4.9 billion on last quarter. Splitting that out a bit more, we can see that our merchandise exports are 71.9 billion euros this quarter, down 23.1 billion on last year, while our imports are 34.5 billion, down 6.9 billion on last year. So we can see that while both are decreasing, the decrease in the merchandise balance is driven by the decreased exports. On the services, we have exports of 92.7 billion, up 6.2 billion euros, largely driven by increases in computer services, and imports of 84.1 billion, down 4.5 billion euros, largely driven by decreases in R&D. Our primary income inflows are 62.6 billion euros, up 29.4 billion on last year, and our outflows are 86.8 billion, up 12.7 billion on last year. Within these, our direct investment profit and interest inflows are 19.8 billion, which are up 15.4 billion on last year, and outflows are 42.8 billion, down 0.3 billion on last year. Looking at the goods imports and exports, we can see that for Q3, goods exports are down compared to last quarter and down compared to last year. And on the import side, we see the same picture, with those also being down compared to last quarter and last year. Looking at how these break out into international trade, goods for processing and other adjustments, we can see that our international trade exports are down 3.4 billion on last quarter and down 5.7 billion on last year, while our goods for processing exports are down 1.6 billion on last quarter, but down 18.7 billion on last year. Merchanting, which is a net export, is up 2.2 billion on last quarter and 1.3 on last year. On the import side, our international trade imports are down 3.6 billion on last quarter and 7.7 billion on last year, while our goods for processing imports are down just 363 million on last quarter and 236 million on last year. So we can see again that this decrease in net exports is driven by the decrease in exports, but that this is driven largely by goods for processing. Looking at our service exports compared to last year, we have an overall increase of 6.2 billion euros, with computer services increasing by 5.8 billion euros. Business services are down 935 million, and within this we see an increase in operational leasing exports of 286 million. Tourism services are down 559 million, and transport services are up 739 million. So we can see that the increase in exports is largely driven by the increases in computer services. On the import side, We have an overall decrease of 4.5 billion on the same quarter last year, with that largely driven by the business services decrease of 4.5 billion. Within this, R&D has decreased by 3.3 billion, while miscellaneous business services have decreased by 1.1 billion. Royalties are up just 136 million on the same quarter last year. So we can see that the decrease in imports is largely driven by the decrease in business services, which is mainly driven by R&D. Looking at that royalty figure a bit more closely, on the graph here we can see the blue line gives us the total royalty imports, while the green bar gives us the amount of royalty imports related to the pharma sector, with the orange bar making up the difference, and most of this is related to the ICT sector. So for pharma, we can see a decrease of 2.3 billion on last quarter and 3.4 billion on last year. But overall, we see a different picture with a quarter-on-quarter increase of 2.4 billion euros and an increase compared to last year of 136 million euros. So with a pharma decrease and an overall increase, both quarter-on-quarter and year-on-year, we have ICT increases that are more than balancing the pharma decreases. Looking at our direct investment income, we have inflows this quarter of 19.8 billion euros, up 15.4 billion on the same quarter last year, and outflows of 42.8 billion euros, down 255 million on the same quarter last year. And these combined give us a decrease in net direct investment income outflows of 15.7 billion compared to last year. Quarter on quarter, our inflows are up 2.7 billion euros and outflows are down 1.2 billion. And these combined give us a decrease in net direct investment income outflows of 3.8 billion compared to last quarter, giving us our net outflows of 23 billion euros. Looking at how these break down by category, we can see that our income on debt is fairly flat as usual. We see a large decrease in dividends in Q3 following the large figure in Q2, and a corresponding large increase in reinvested earnings, bringing them back positive this quarter. Looking at how those profit outflows break down by sector, we can see that compared to last quarter, we have a decrease in the manufacturing sector of 1.1 billion euros and a decrease in the information and communication sector, which is down 2.4 billion euros. But year on year, while we see a decrease in the manufacturing sector, which is down 9.4 billion euros, we have an increase in the information and communication sector, up 4.2 billion. Looking at our current account with the UK, the trade balance with the UK has increased by 4.3 billion and net income outflows have increased by 3.4 billion compared with the third quarter of 22. And the result is a current account deficit of 5.8 billion euros in this quarter, up 0.8 billion from the deficit of 5 billion in the third quarter of 2022. Looking at our financial account changes, we have an increase in direct investment abroad of 7.1 billion euros and an increase in direct investment in Ireland of 23.7 billion euros. And these combined give us a net decrease in direct investment of 16.5 billion euros. Portfolio investment net assets have increased by 45.6 billion, while other investment net assets have decreased by 9.7 billion euros. The net international investment position stands at minus 577.6 billion at the end of September 23, which is an increase of 15.2 billion on the end of June figure. And this is largely driven by changes in non-financial corporations. So to summarise, we have a current account balance in Q3 23 of 20.8 billion euro or 16.2% of GDP. We have a decreased merchandise balance, increased services balance, and decreased income outflows this quarter. So now I'd like to pass back to Jennifer to summarise. Thank you.
Many thanks to John and to Chris for taking us through the results. So look, I might just refresh our minds on some of the headline results from the national accounts as people are developing some questions. And as I say, questions can go into the chat or raise your hand, and also we can take questions in the room. So for quarter 3 23 and quarter 2 23, we see GDP has decreased or contracted by 1.9%. And just to bear in mind, GDP is that whole of economy indicator. At this stage of the year, we can look at the first 9 months compared to last year as well, and for that comparison, we're seeing GDP contracting by 1.3%. If we look then at what's driving that, so lots of moving parts, but I suppose a key driver behind it is that contraction in the multinational dominated sectors, as explained by Chris and John. So quarter on quarter, we're seeing a 3.8% decrease, and then we're seeing a 2.7% contraction looking at the year-on-year comparison. But as we've said, 2022 was a particularly strong year, and if we look at the trend over the number of years, we still see that significant, I suppose, increase in activity for the multinational dominated sectors if we take that longer view. So it's, the outturn for the year, I suppose, is still to be determined. For the other sectors, the more domestically focused sectors, we see a contraction of 0.7% quarter on quarter, and actually an increase of growth there of 4% when we look at the year-on-year comparisons. Looking then, I suppose, at the more domestically focused indicators that we have, our modified domestic demand, which looks at personal, government and investment spending, removing the impact of IP and aircraft. That's flat in the quarter and up 0.8% year on year. Consumption then, the personal consumption expenditure indicator, which is what we all spend on goods and services, so which is a very domestically focused indicator, that's up 0.7% quarter on quarter and actually up 3.6% year on year. And again, I think just to underline the point about the inflationary impact on that personal consumption. So what we've had to spend to keep the volumes even steadier, to increase the volumes. So small increases, but obviously in without taking out the price impact, you see those big current price jumps in consumption, both in the quarter and year on year. So worth noting that, I think, but important obviously to look at the constant price estimates as well. Okay.